For Canadian investors, one of the most practical decisions when building a portfolio is whether to hold US-listed ETFs directly, or to use Canadian-domiciled equivalents traded right here on the TSX. The underlying markets they track are often nearly identical, but Canadian ETFs come with their own trade-offs around currency exposure, tax treatment, and everyday convenience. In this video, we're going to walk through exactly how a Canadian investor might construct a diversified portfolio using only TSX-listed ETFs. We'll cover broad equity coverage, fixed income, and a handful of practical details that most people overlook until it's too late. And to keep things focused, we're deliberately setting aside one thing: the growth versus value style split. More on why in a few minutes. If you're new to ETFs in general, the short version is this: an ETF is a single ticker that holds a basket of underlying securities, so buying one share can give you exposure to hundreds or even thousands of individual stocks or bonds at once. Everything we cover today builds on that basic idea, just applied specifically to what's available on the Canadian market. Let's start with the foundation. The core of most portfolios is broad equity exposure, and for a Canadian investor, the first real decision is how much of the portfolio goes to Canada itself versus the rest of the world. Vanguard's FTSE Canada All-Cap Index ETF, ticker VCN, offers a simple way to capture the entire Canadian stock market in one holding, spanning large, mid, and small-cap companies. But here's the catch: the Canadian market is heavily concentrated in financials and energy. VCN alone should never be treated as a complete portfolio, since it represents only a small fraction of global market capitalization, even though a lot of Canadian investors choose to overweight it anyway, mostly for currency familiarity and the dividend tax credit. For U.S. market exposure, the most direct option is VUN, the Vanguard U.S. Total Market Index ETF. VUN is a Canadian dollar-denominated, unhedged wrapper that effectively holds the entire U.S. equity market, playing a role very similar to VTI for American investors. Its iShares equivalent, XEQT, tracks a comparable index and works almost the same way. Both of these are unhedged, which means your returns will be affected by movements in the Canadian dollar versus the US dollar, and that's worth understanding clearly before you commit any capital to it. Beyond North America, VIU, the Vanguard FTSE Developed All-Cap X North America Index ETF, covers developed international markets, think Europe, Japan, and Australia. VEE adds emerging markets on top of that, places like China, India, and Brazil. Combining VIU and VEE approximates the role that VXUS plays in a US-based portfolio, though the underlying index construction isn't identical, so think of the overlap as close, not exact. Put together, a simple four-fund equity core looks like this: VCN for Canada, VUN for the US, and VIU plus VEE for international developed and emerging markets. Now, if managing four separate tickers and rebalancing them yourself sounds like more work than you want, there's a shortcut. All-in-one funds like VEQT, or its iShares counterpart XEQT, bundle these four building blocks into a single ticker, and they automatically rebalance over time for you. One thing worth flagging though: these all-in-one funds typically tilt more heavily toward Canada than pure global market cap weighting would suggest. That's a deliberate design choice by the fund providers, not an oversight, so go in with your eyes open about that home country bias. Equity exposure addresses long-term growth, but most portfolios also need a mechanism to manage volatility along the way, and that's where Canadian bond ETFs come in. Just as U.S. investors might pair a total stock market fund with long-term treasuries, Canadian investors have access to a similar spectrum of government bond ETFs, differentiated mainly by duration. Let's break down the three main options you'll come across. Short-term bond ETFs, like Vanguard's VSB, hold Canadian government and investment-grade corporate bonds with shorter maturities. These are less sensitive to interest rate changes, and they behave more like a defensive, almost cash-like allocation. On the other end of the spectrum, long-term bond ETFs like VLB hold longer maturity Canadian government bonds. These carry much higher interest rate sensitivity, they tend to perform well when rates fall, and they can decline sharply when rates rise. For a broader, one-decision approach, VAB, the Vanguard Canadian Aggregate Bond Index ETF, blends government and corporate bonds across the full maturity spectrum, giving you a middle ground between the two extremes. One limitation worth calling out directly: Canadian government bonds do not move in perfect lockstep with U.S. Treasuries, since they respond to a different central bank, different inflation dynamics, and different currency considerations. If you're used to thinking about VGLT or VGSH in a US context, don't assume the Canadian equivalents will behave identically. The general logic still holds: shorter duration means less sensitivity, but the specific magnitude and timing of that sensitivity can diverge quite a bit between the two countries. Now, back to that deliberate omission from earlier: growth versus value. Some US investors split the market into funds like VUG and VTV, expressing a specific view on valuation versus earnings momentum. The Canadian ETF shelf simply doesn't offer a rich, liquid set of factor-tilted, broad market-style funds comparable to what exists in the US market. A Canadian investor could technically still access growth or value tilts by buying US-listed ETFs directly, but doing that within a purely Canadian-domiciled framework isn't practical or well-supported. So this style dimension is left out of this framework by design, not by oversight. Before you buy anything, there are 3 practical factors worth understanding. First, currency hedging is a real decision, not a footnote. Many Canadian ETFs come in both hedged and unhedged versions, for example VUS versus VUN for US equity exposure. Choosing unhedged exposure means your portfolio's returns will be influenced by the Canadian dollar to US dollar exchange rate, on top of the underlying market's own performance. Hedged versions try to strip that currency effect out, usually at a slightly higher management fee. Second, your account type matters a lot for tax efficiency. Holding Canadian-listed ETFs that themselves invest in US or international equities, inside a TFSA, an RRSP, or a non-registered account, can produce genuinely different withholding tax outcomes on foreign dividends. RRSPs specifically benefit from a treaty exemption on US-sourced dividends when you hold US-listed ETFs directly, and that advantage is partially lost when you go through a Canadian-domiciled wrapper instead. This is a real area of complexity, so talk to a tax professional before finalizing where you place each fund. Third, and simplest to check, management expense ratios on Canadian all-in-one and wrapper ETFs tend to run slightly higher than their unwrapped US counterparts. That reflects both the cost of currency conversion and an extra layer of fund structure sitting on top. Over long holding periods, even small differences in fees compound meaningfully, so it's worth comparing the MERs of the individual building blocks against an all-in-one option before deciding which approach fits you better: simplicity or cost minimization. So let's put it all together. A Canadian investor does not need to look beyond the TSX to build a genuinely diversified, low-cost portfolio. Combine VCN for domestic equity, VUN for US equity, VIU and VEE for international developed and emerging markets, and a bond allocation drawn from VSB, VLB, or the aggregate VAB. That structure mirrors the logic of well-known US portfolios, while staying entirely in Canadian dollar, Canadian domiciled products. If you'd rather have a single ticker solution, VEQT or XEQT bundle the equity side automatically, at the cost of that built-in home country tilt. And remember, we left out the growth versus value split on purpose, because Canadian markets just don't have the same depth of style-based products the US market does. Adapt the specific weights to your own risk tolerance, time horizon, and tax situation. This video is a framework, not personalized advice. Nothing here should be treated as a recommendation to buy any specific security, and past index performance is never a guarantee of future results. Do your own research, check current fund fact sheets before investing, and if you're unsure how any of this applies to your own tax situation, a qualified accountant or financial advisor is worth the conversation. That's the full framework for building a Canadian ETF portfolio without ever leaving the TSX. Which building block would you swap out for your own portfolio? More Canada, less Canada, longer bonds, shorter bonds? Drop your answer in the comments, and if this was useful, consider subscribing for more breakdowns like this one.